Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, August 1st, 2024. Today's episode, bear market begins. At least I think it is, and it totally makes sense with everything going on. TLT cracking higher as I expected after that jump over the river that we had yesterday. Friday unemployment comes out, expected to be flat at 4.1%. I personally expect it to be higher than this number. I expect this where the Fed is cutting in September, guaranteed. We'll talk about that in a minute. They see, they want to save the job market before it collapses, and it's collapsing. I mean, that's what's happening. The number has to confirm it. I guess we'll see what happens Friday morning. Could I be wrong with my crystal ball? No way. I don't think so. Daily reminder, 2-year, 10-year yield curve inversion past its second birthday, which by historical standards mean we're probably headed into a pretty darn bad slowdown in the economy. I've been hearing people talk about how China is already in a depression. Europe, pretty much a lot of the rest of the world is already there. Sometimes those often act as leading indicators of what's going to happen in the United States. And so buckle up, everybody. I wanted to bring up Amazon. Wow, down almost 7% now in the after hours, because I mentioned it in previous shows about how it can affect markets. And its earnings came out after the bell today, and obviously those did not come out to be too good. And as I mentioned in the show yesterday, I do like to use Amazon as sort of a leading indicator. Everyone I know uses Amazon all the time, and so if they're hurting, it means people are buying less stuff, and that's huge for me, adding to my case that we're headed into the slowdown. The writing is on the wall. Is that the right statement? Yeah, I looked it up. The writing is on the wall. But if you're like me and you have 50% of your assets in treasury bonds, you're not going to be suffering while people are hoping, begin to chase yield and realize that the companies that they own in their stock portfolios are going to continue to make less money. I've been saying the same thing for a long time now, and it's just becoming more and more evident and obvious. Right here, I'm showing you right now a chart of the S&P 500 earnings by quarter. It goes back 90 years, but I've brought this up lots of times before. In end of 2021, beginning of 2022, the earnings per share of the entire S&P 500 was around $197, and we haven't seen it get that high since then. And right now, we're seeing company after company saying people don't have money, they're not spending money, these companies are not going to be earning as much money, all while the borrowing costs have gone way the heck up because the Fed funds rate has been ballooned like faster than any time in history. It's just the writing's on the wall. This is not easy. This is not difficult to see what's going on here at this point. I think the bear market's starting today. But anyway, TLT, like I said, we jumped over this line, which represents a very long-term head and shoulders, inverse head and shoulders, starting I believe it's August of 2022, if you want to draw it out yourself and take a look. And we had another nice pop up today in the value of TLT. At one point it was up 1.4%, which is a very large move. That's a large move for the value of treasury bonds and yields to be going down like that. I mentioned a few shows ago how I wanted to also see the 30-year bond yield crack this line here, which I drew as its corresponding head and shoulders, and obviously when this goes down, it gives a lot of value to TLT, and we cracked through it today. And so I expect bonds to continue doing well here. Garrett's all the way on his show. I know I talk about him a lot. I'm getting a little sick of him at this point, but he's out of TLT, maybe smartly so. I'm very curious to see how this plays out, if he made the right call in getting out of it today. or not. I'm holding because I'm seeing this as a longer term investment until we see, credit spreads widen enough so that high yield corporate begins to look very interesting. And that's sort of my plan, to get out of treasuries and get into high yield corporate when it's cheap. Graham would love that, and that's my plan. But as you saw earlier, or no, we didn't go over that chart yet. HYG, we'll go over that now. HYG, I've decided to use HYG instead of HYT just because it has, it's a little wider of a fund. It dropped today, but a lot of that was because of the dividend payment, so we're basically flat. So this market still doesn't see as much fear as the rest of the markets today. Anyway, going back to the yields, one more yield I want to share is the 10-year yield. Also the same corresponding head and shoulders to the downside, large gap and red candle down. How low will it go? Like I said, Gareth's always been doing chart patterns for 25 years as his career, and he's out of this, so it could be a good time to get out. But again, I'm not getting out myself until, I already explained it. SPX, the S&P 500, yesterday it looked like there had been strength coming back. I didn't know what to do with it, and today we flushed out hugely. Also the VIX is up a lot today. IWM, chart pattern wise, is surprising, but it's not surprising to me to see such a ginormous move down. We're down 3.25% from yesterday. Granted, we're back to the same price that we were only 2 weeks ago, so is that the end of the world? Well, a candle like this is formidable, I'll just say, and this can easily turn into send things going lower. This is a very serious looking candle, not one to be messed with. I'm not, I had said previously, like, maybe it looks like buy the dip, maybe it looks like, I'm not sure which way things might be going. I'm a little more sure now. I think the top is in. I think markets are headed down here, but I'm just the guy with a crystal ball. So triple Qs, the Nasdaq, also large move down today, 2.4% down for the day, pretty large move down. If you go through pretty much every index of almost everything went down like massively today except for bonds. And so it just says that everybody's selling stuff for cash and bonds, basically, except for gold. Gold also did okay today, but not every equity went down. One equity that I've been tracking because of its seemingly attractive valuation, Next Era Energy company, NEE, was actually up almost 3% today. And that's one of the beauties of value stocks, is that they can function sort of, especially like public utility stocks. Like, people aren't going to turn their lights off. People aren't going to stop using their refrigerators and stop paying their electric bill. I don't know, some people might, but these companies are not going to stop paying money, and so they function more like a treasury bond because they know the money is coming in no matter what. Amazon doesn't know. Walmart doesn't know. McDonald's doesn't know. People could stop, people could be like, I don't even have enough money to go to McDonald's, and they are saying that, by the way. And so they don't have as much pricing power as, like, utilities, that area. So anyway, again, the move into cash and bonds. This is the U.S. Treasury yield curve. The blue is today. The whole curve has been collapsing. You can't see it that well in this chart, but the fact that the blue line, you can see clearly below, the entire blue line is clearly below these other lines, which I pinned as the last few trading days. We have 4 other days on there. Yields across the whole curve has been really collapsing, and this is when this happens, when you have the short end, when you have the shorter end falling assumably eventually below the long end, that basically states that there's a recession, there's a big slowdown here, and the writing's on the wall. Yeah. So that's all I have for today's show. Hope you enjoyed. Thank you for watching. Robschild.